I guess let's start with liquidity. Why don't we do that? So liquidity is in the shitter. Uh, Nothing has really it changed. We did get a little bit of a bounce in equities, but liquidity conditions remain at turbo puke. The thing with the liquidity though is it's not the best leading indicator because it does somewhat coincide with the stock market. Like once liquidity conditions start regaining and getting better, I think the Nasdaq is already going to be mid bounce at that point. Wouldn't you say that's probably the way it's going to work?
Yeah, so the thing you have to understand about liquidity, right? Like liquidity itself, if liquidity is constrained, then the effects on asset prices and available money in the market, not let's not talk about the economy. The market itself is constrained. So like if you think about it like this, liquidity can fall while the market rises, but the odds of it being in this territory is like while the market is extremely high is quite low, the likely the liquidity indexes would be higher. But you can kind of use it as a confirmation indicator as if like the equities are reversing and then liquidity starts rising and then you're like, okay, like we can lift out of the puke zone, we can get into bid, we can hold that zone. And it's something that gives you basically confirmation of what's going on. It's not going to give you like the, oh, we're in turbo puke and S&P is at all-time highs. That's not what's going to happen, right? And fortunately for us, like the way our system operates, we don't need these liquidity indications to move the system and our positioning around. This is more so a confirmation indicator that, look, we're in risk off right now. We've been in risk off for quite some time. We started in a slowdown in December. And if you, as you notice from here, right? Like um just take let's look at Nasdaq, right? So we'll show them next to each other. We leave turbo puke here Jan 17th and we go into bid on Jan 21st. So Jan 17th is here, right? And then we go into bid 21st, which is up here, pretty much, right? So like we're not at all-time highs, but we're back into bid. So like that means that like the dip should be supported. There should be a positive flow of future buying, right? Think of it like a more of like an amplifying effect. So positive flow of future buying, dips get bought, we go up, and then things start breaking down pretty quickly. Now, if you notice here, Feb 21st is really where this whole unwind starts happening. And the liquidity index is by Feb 21st, it's off the highs and it's starting to fall. And we flip down here in Feb 25. But by then, Feb 25, market's already, down here. So it's not going to like give you the opportunity to buy some like far out butterfly SPY puts or something like for pennies and turn them into dollars. That's not what this is going to do. It's more of a confirmation indicator telling you, okay, like what this is telling me right now is when it's technically off the charts, it's just at values that are historically um irrelevant, like they're beyond the range of historical context where it even matters. Like what we figured out is the levels to break this down where when we're below these values into turbo puke, it doesn't really matter where we go below, right? Like it doesn't matter if it's call this -10, -50, -100, -1000. At that point, it doesn't matter. You're essentially in an environment that all bounces are fades unless proven otherwise, which is, I mean, like this is what we're seeing, right? All these wicks on the Qs. It's something that just is going to happen when you're in this zone of liquidity. Now, if this starts lifting with the Qs and we maybe say start normalizing in puke or even back at bid, then I'd say, okay, like if we can get above mid vamp, we really have high odds of getting up there. But again, they kind of work together. It's not going to give you the, eye in the sky, golden leading indicator that you're allowed to place ridiculous bets on. Because like you said already at the beginning, liquidity itself is a function of the market, right? Like it's not like you're going to get the poorest liquidity readings at all-time highs. And it's not like you're going to get the best liquidity readings at all-time lows or not 52-week lows, right? Or whatever, however you want to put it, local lows. And that's just how this works. Um,
Yeah, the liquidity is really just a confirmatory tool. Like if you really want leading indicator, the holy grail, that's really the system. The system is the leading indicator that we use. Everything else is just confirmation um, for our trades. And it is nice when you're long the Nasdaq and you see that liquidity conditions are in turbo bid. Like it's things are pretty solid, um, and you can kind of tell when conditions are deteriorating before they fully happen. But it's not really that much of a leading indicator. More so just to confirm. But yeah, let's talk about bonds. So TLT went bullish trend today. We almost got a trigger to go into bonds, but
It
sold
didn't close
off.
bullish trend. Didn't close.
Yeah,
It
did
flipped
not
early this morning.
close.
Yeah. Yeah, it didn't close.
Um, but yeah, like we were saying, it really is like TLT is trying to run with a weighted vest on. It's just being held back. Uh, Still with this deficit issue looming. Is there anything new that you've been seeing that's looming on TLT as well?
I think that the biggest issue that we're seeing in terms of the deficit issue to touch on is that we don't really know what's happening here. I mean, there's projections, right, of the cuts that are being made. The issue that I'm seeing, at least just from an observation standpoint, is that a lot of these cuts are being brought back up into court, and they're having like issues legally with them. Maybe they shouldn't. Maybe it should be a simple. Maybe it should be a simple thing. But in this case, in the real world here, they're running into legal issues with these cuts, and no one really knows exactly where the deficit is going based on the rapid amount of applied cuts and what's sticking versus what is going to be held up and denied or revoked in the courtroom. So I think that's probably what the biggest the biggest underlying factor right now that we're seeing in the bond market. And on top of that is, there's not really a recession, right? Like we're seeing the slowdown really hit the tape, and it seems to be such a spread out event where things aren't necessarily coming in all negative all at once, right? We're having better like if you look at it from a continuing jobless claims, right? So like they're slowly weakening, right? The continuing claims. I believe that this is not reflective of, let's see. Maybe it is. Um the No, it's not. See, this is out of date. But long story short, the continuing claims are around this level, right? So like if we zoom out and we look at where we were in just other cycles, right? Like it's not necessarily at points that are like, oh my God, things are falling apart. And it's just something that, again, take COVID out of the equation here. If we just zoom in, like continuing claims don't look terrible, but they continue to weaken type of thing, right? Like there's this progressive deterioration in the labor market. And the issue that you're seeing more than not is that not so many people are losing their jobs. It's just people are having a hard time finding a job once they do lose their job. And
Yeah.
that's more of what what Powell said this week as well. And I think that this is kind of what is holding back bonds. I mean, I want to be long bonds, right? Like I was excited this morning. I was like, okay, here we go. Time to turbo bid this. But we sold off the entire gap. And that's, I mean, in a way that's also constructive, right? From a technical standpoint, like if we start reversing higher from here, there's less like, oh, we have to go back and fill the gap and all that nonsense, right? Like sometimes gaps fill, sometimes they don't, but more often times than not, they do get filled. So like it's better to have that done before we run 3x leverage on the tape and then, have to deal with some nonsense to the downside. Not that we wouldn't, but it's just one less thing we'd have to worry about if we get flipped on into the bonds.
Yeah. Something that is interesting is we are seeing a lot of slowdown data. Not all the data is bad, but there is key points that are pointing towards slowdown. I think the market is very much in the slowdown camp right now, but we're not seeing utilities and healthcare making any progress, which that's surprising to me. And the system is picking up on that. There's a reason why we're not in the slowdown regime at the moment, but I'm just wondering why healthcare and utilities are struggling so much.
That's a good question. So let's actually talk about that. Let's look at utilities first, right? Utilities aren't progressing much. As to be expected, we've moved out of the the slowdown regime last month, and we've been in pretty much risk off for well over a month now, right? And this risk off barrier is something that utilities and healthcare tend to not do the best in. But what's important here is to understand that the system is not taking the position because it doesn't see the nominal performance there, right? The system is saying like, okay, we're not going to be able to capture that. There's not enough upside juice for us to go long utilities when the growth is this in in the shitter. However, if you take a look at utilities and just do like a quick ratio against SPY, right? They're up quite a bit. Like I remember drawing this like triangle or whatnot months ago, back in I don't know December, January, right? Saying that there would be some alpha to be had here against S&P, SPY, SPX with utilities. And this is one of these things where it's like, yeah, you're not making money with um you're making money relatively, not outright, right? And the system doesn't look for relative gains. The system wants we don't want to put on a 3 times leverage position and be like, oh yeah, like here's a good example. UTSL, right, to SPY. Like with the vol drag, it doesn't even look that good compared to, the unleveraged version. But nonetheless, we don't want to put on a position and be like, oh yeah, like we're up on a relative basis, but UTSL could could be down. Like if we look at UTSL, right? And we look at what it's been doing, if you look at it, depending on where you bought this, like you could be chopped up in some vol or you could be flat. And the system doesn't look to just take on positions that are relatively better than SPY. It's looking to make money. So if the reason that utilities aren't necessarily down is probably because we're in this semi slowdown risk off environment. It's obviously this is something that I think you guys who look at the models, you need to understand that just because the growth is negative 85% right now does not mean GFC shit is going to happen. Okay? Like it just means that on a on a scoring basis, growth is very very weak. But this is not a GDP now forecast. This is more of a directional and impulse forecast of what is likely to come with growth moving forward. So think of it like this. Like, we take a look at GDP now. Let's look at that, right? You'll see here that we know that this is heavily manipulated with gold imports and whatnot, but the whole point is that we were coming from plus 3% at the beginning of the Q1 25 estimates, and we're somewhere around on this model hovering around 0 to 1, right? And the importance of this is that this negative growth impulse here that we're seeing has been negative pretty much this whole year. And what this is telling us is that weakness should continue in growth if it's GDP, if it's earnings, if it's whatever it is. There's this negative connotation around the growth factor in the market right now. And as long as that's negative, doesn't mean crisis. It just means there's weakness ahead. Now, could this be the bottom? Could we start to see like these slowdown fears bottom out in the market? It's possible because remember this, right? Like you have to always like we're bulls at heart. We love being risk on. We're risk on enthusiasts at heart. So you have to look at it from a perspective like this. The slowdown's hitting the tape. Now, what happens when the slowdown can't slow down anymore? Yeah, you basically price in all the bad news, right? Well, then what happens is you have the reversion where you kind of get lifted out if it's expansion or if it's inflation regime, whatever it may be. You lift out of the slowdown, right? You come up and go growth positive. Now, how that is going to be reflected is going to be really coming down to one thing, right? Like not only are we having these growth slowdowns, but we're having slowdowns that are attributed to uncertainty, right? We're not necessarily having a consumer that's going bankrupt or that's losing jobs or getting a mass amounts of layoffs that are just compounding in the background. What's going on here is you're having people basically pull the scent. This market is driven down mainly at this point by sentiment shifts and uncertainty around trade. And that is what I think is causing a lot of the slowdown fear. And as that continues, it kind of grows across the economy. It doesn't just stay in one sector, right? Like eventually what ends up happening, employment's the slowest to move indicator. You run into a situation where if this uncertainty continues and compounds and it becomes and continues to become more uncertain, eventually layoffs start happening because the uncertainty has bled from just sentiment to actual bottom line hard data issues. And I think that we're not at that bottom hard line data issue yet. So there is the possibility that Q2 or second half of the year, maybe we need another quarter of this uncertainty, whatnot, where the market can be at all-time highs again. This is not me saying like, oh, we're going there, but it's also me saying like you can't sit here and say recession is the base case, because that's just, there are more people lose more money shorting against a recession than you could possibly imagine, right? Like the idea that like, or sidelining, right? So you say, oh yeah, like stocks are too expensive, right? And that's a qualitative observation, right? Like you're looking at the data and you're saying stocks are too expensive, you know, or the quality of the stocks are above what they're worth, excuse me, the price is above what the quality of the stock's actually worth, and therefore I don't want to buy it. And this is what has led a lot of people to miss a lot of bull markets over the last 20 years. So you have to be very conscious about how you make these decisions. We're not just looking at the S&P and saying, oh, SPX is at a 19 multiple. It was at 21. 19 is historically still above the average of 15 or so. It's still way too expensive. Like that's a ridiculous way to look at the markets, because as you know, right, like PE multiple, price and earnings, prices can go up a lot, but then earnings can rise later. Or
Yeah.
because so like it's such a distorted multiple that you just need to understand that the way we look at the market is we don't base case call a recession, never do. If we get a recession, I want to say that you have to expect that there are some negative consequences in this environment. We're risk off, the Nasdaq is bearish trend. That's how you should build your fundamental basis. You put it on a piece of paper. Regime risk off, bearish trend Nasdaq. What does that mean? Well, if we stay risk off in bearish trend Nasdaq and these uncertainties continue to compound and they don't get resolved, well, what's going to happen is likely the Nasdaq is going to go lower, right? As long as that bearish trend holds. And as long as that risk regime holds, well, it's going to only accelerate that fear in the market and again push equities lower. So you kind of have to benchmark it and say, okay, if we're in this environment, I expect lower prices. I don't expect a crisis or a recession, but I don't expect it to be favorable for the bulls until we get some resolution on trend on the Nasdaq and or regime flip. And
Yeah.
I think that that's where we got to pretty much sit right now, because the market, obviously, like the market's pretty, there's obviously uncertainty eating away at the market. I know that there are some comments saying that that's couldn't be the case, but it's obvious, right, based on where stocks have gone. And we're seeing stuff show up on earnings releases now with tariff uncertainty. Like it's obvious that there's some negative effects of tariff uncertainty on the market. The question is how that compounds and basically grows and solidifies over the next couple of quarters. And I think that's where we got to focus our energy on right now.
Yeah, and historically, the market doesn't like to be in that limbo, wishy-washy, stagflationary environment. It's very uncomfortable in that environment, and there's usually a strong move in one direction. Either you go to deflation, which is what our system just picked up, so likely we head towards deflation and further downside, or we get a swing up, a hard swing up back into risk on. That's typically what happens. We saw that last time we had a stagflationary period. It did last a long time, actually, one of the longest stagflationary periods that our system has. Like historically, they do not last that long because the market is uncomfortable and then it shoots out of it. And it did shoot out of it. We went strong risk on after that stagflationary period. And I think that's something we can expect from this too. Either risk on or heavy deflation, and you get that strong bond trade.
Yeah. So I think to touch on what you said there, right? Like, just remember, let's go back to 2023. End of the year. There were some Dam Springs was talking about term premium all over. Like, basically, his call did nail the lows here on the term premium call, where he was able to emphasize the issue of the Fed moving issuances around on the curve, and the Treasury, excuse me, moving issuances around on the curve, and being able to kind of take some of that duration risk out of the market. And equities ran. Now, I'm not a big believer in term premium, right? I just I think that pre GFC term premium was probably useful. And after the GFC and after the Fed dropped the 2% inflation mandate, I think term premium is more of like it's more noise than it is value, because the Fed has made it abundantly clear the last 2 years, right? That people say 3% is the new 2%, but the Fed is very clear on getting inflation down to 2%. Now, it might take them some time for sure to do it, and they might take the easy road by lowering it real slow, but their intention is to get to 2%. They've shown no signs of that shifting, at least at the moment. And long story short, we'll go back to 2023, right? You have this bearish trend. Now, unfortunately, the bearish trend trigger here in 23 was literally the low in the NASDAQ move. And then we have this gap up and move, go bullish trend again, and off to the races we go, right? But the objective here is like, look, we can have a move up here and we can start going bullish trend. Now, this doesn't happen quite often. I mean, more times than not, you get a bearish trend. Oh, this is COVID. You get a bearish trend where like there will be significant price declines if you're not careful. So the key here is to say, look, we're in a bearish trend. Now, like you just said already, we can revert, we can blast, we can flip risk on, we can go, but caution is the appropriate response at this point. Now, that's why I'm constantly questioning things on X when I make these posts. I say, look, if we bounce on the Qs, we can bounce to 500. But like, that's just a Momo check, right? And you go back to 22, look at that. Like, we had multiple close to Momo checks, right? Like we bounce back and we fade. We bounce back, we fade. We bounce back, we fade. And I'm not calling for no severe drawdowns or anything like that. I'm just saying we've yet to get a real check back. Someone claimed that this was the check back in early March, but that's not real. This has all been one move. We're kind of starting to break that, right? Like, if we just take this onto a line chart, I like using line charts for this because you really can understand what's going on. And you just take a trend line, you just go from the top to the bottom. This is one move. This has been a straight move down. So now the question is where the congestion happens, where you start accepting above and below, how price starts progressing from here. And we've had one straight move down.
Yeah.
So a bounce up here is it should be expected. What happens up here, I think, will set the tone for how we continue going forward. So right now we're more in like a limbo mode. There's not much to do right now. We're just waiting,
I
right? For
think
risk assets.
I think it is very possible, given where growth is at the moment and how destroyed it is now. I think it's very possible we do get a growth bounce from here, which would coincide with a bear market rally. And then from there, it's going to be dependent on how strong that growth is able to maintain and continue. And
Right.
that's what's going to determine whether we get into the Nasdaq. And the beauty of it is like we use triple leverage. It doesn't matter if we get in late. We're not timing
Right.
tops and bottoms. We can get into the Qs at new all-time highs and still make 30% from there. It's not a big deal. But like when it's a period like right now where you have bearish trend, it's risk off. It's better to exercise caution, especially when you use leverage, especially with leverage.
Absolutely. I mean, look, let's just look at TQQQ for a second, right? Absolute destruction the last couple of weeks, just destruction, right? And I believe we dumped this here. So we dumped this up here back in December. And what is going to happen now with this is the Qs are going to go back up to all-time highs at some point, right? I don't think the market's indefinitely topped, right? The Qs are going to go back up to all-time highs. Excuse me, I don't believe the markets have definitely topped. I know there's some people out there that say this is the end of America, it's all over, right? The Qs will The Qs may even hit all-time highs again this year. It's possible, right? Obviously, given we need that bullish trend flip. Nonetheless, when the Qs get back up to all-time highs, this will not be up there, especially if this takes a lot longer now. And that's going to be because you're basically getting decayed on by high vol. Like if VIX is 19 plus, it's chopping, markets are chopping. You're rebalancing this ETF every single day, right? And likely at loss, like you're taking it on the chin, right? So it's not effective here at this point, right? Like if you wanted to buy the dip and you want to be a hero, you want to try and play hero, I probably wouldn't use the leverage ETFs. If you keep on dipping, you have that you have that vol exposure, you have that downside exposure in case these aren't the lows. I think like there's a crowd out there that just is a DCA crew, and like for them, these are great prices. These are prices to start DCAing into if you haven't, right? Like this is just long term. You're off highs. You eventually the market will go up, and I think we can get onto that next, right? That's the big talk on the street now is that it's over. It's cooked for America. It's over.
No, not at all.
Absolutely not. No. But
I mean, when everyone's looking at the eurozone and making new highs, looking at China as well, everyone's saying, "Oh, you got to invest in China now." What are your thoughts on that?
oh, well, I'll tell you this much. So let's just look at the eurozone right now, and this is priced in U.S. dollars, right? Believe it or not, it kind of looks like shit. You might be like, oh yeah, it's all time highs, right? But like, let's just understand where we are from 21, right? Like eurozone up 18%, right, since 21, and this is the caveat. It's more effective, like if you look at it on a currency basis. So like, let's go look at euro, right? Let's see how this looks on euro. Oh, now that's different, right? That looks a little bit different now. That's because the euro's been so shit that like the index looks better on a euro basis than it does on a dollar basis. On top of that, right? You have this massive one move wave. Okay, let's look at it from this perspective. Let's go back to December, right? Remember last year, end of last year, Fed stops, they hold policy steady, and since then, pretty much new year, up in a straight line. It's not like this has been doing a lot of like damage, especially when we break it down into like a relative basis on America. Now let's look at it on a relative basis like this, right? It looks crazy the last like couple months, right? Like going from literally from the beginning of the year to now, crazy. But when you zoom out, it's just like, okay, we're back to where we were at this time last year. So all the losses from on a relative basis against eurozone from America in the last year have been erased. But like, I mean, are you going to call a generational bottom here? Because I don't think that's here.
Yeah, I think
I and
America's
I,
definitely going to continue to outperform it. You can't really stop a train like that.
and I'll tell you why. Number one is the deficits. Okay, like on a foreign basis, no one can really compete with America's deficits because they don't have reserve currency status. So they can't get everyone to buy their debt the way America can. Now you may say, oh well, that's got to change at some point. It does, and the deficits do have to go down. But in our sheer power, like look at the top companies in the world. Most of them are U.S. dollar denominated. Most of them are based in U.S. Right? So forget about treasury bonds because that's only half the equation. When the world's products are priced in dollars, theoretically on the bottom line, right? Like they end up on U.S. dollar balance sheets, iPhones, everything like that. What ends up happening is you have more. It's not just the treasury that's drawing dollars globally. You have corporations themselves that are dollar based, dollar assets that are drawing dollars globally as well. And unless you start like, I'd say like if we started to see here, let's just look at here. When we start to see like more Chinese companies in the top 10 than American companies, I'd say okay, or the top 20, right? I'd say, oh, okay, or half, or like a proportional slide. I'd say, okay, we have an issue, but you don't. And I think that you're in this phase now where okay, so the European sentiment around America is pretty shit. It's pretty shit, unfortunately. Like It's not that they don't. It's especially politicized. I don't know if you've ever been to Europe, but they don't speak nicely about U.S. politics. It's
I feel like
always
most of the world doesn't speak
yeah,
nicely of US politics.
yeah. And I know Trump is like a noisemaker, and I'm not saying he's not a doer, but he's definitely a noisemaker, right? He'll make the noise before he does it. And I think that the Europeans they harp on it, and there's nothing wrong with Europeans, right? I love Europe. I'm a Swiss citizen, so I have great respect for the countries over there. I obviously don't want any civil unrest and things like some of these, patriots over in this country. America like to say Europe should go to shit. I don't believe that. I do think that the way that they affect the way that they absorb information is a bit skewed. Their media intakes. I mean, I've been over in those countries. I've seen the news. You just have to spend a couple of days just watching news, and you'll understand what I'm talking about. It's very polarized against America. So I think that like all these Europeans are starting to see like this idea that their countries are going to stand up and make a difference against America, against America's global outreach or globalization, and that may alone have sparked a lot of capital retracement back to Europe. If it's like the idea that Donald Trump is going to be the downfall of America, right? Or something asinine like this. And I think that coupled with the fact that equity markets are seeing some constraint with a higher euro, right? The euro is getting stronger, it's pulling capital back home. And I think that alone also is weighing on our markets, right? That's a little bit of a release valve that we're seeing happen there.
Yeah.
And I
Yeah,
don't
we
think it's
we
permanent
just yeah,
though,
we got to see how long it lasts and if it really puts in a long-term trend. But I
because
think
the thing that
like we should make a system for Europe. I think that would be kind of cool to see how they're looking on a system basis.
I actually have something in the works for that. I have some euro based. I basically have a euro based growth and inflation model. The only problem is that it's priced in euros, right? So, as an American and as most of our followers, we're looking at American assets, but I know we definitely have some European followers, right? I'm sure we do. We're focused on U.S. assets priced in U.S. dollars. So, like, let's go back to eurozone, right? Like if we look at the eurozone on a dollar basis, it's kind of shit. I mean, it's not bad, but like again, 2021 to where we are right now is 18%. QQQ, right? 2021 to where we are right now is what? Let's see. Is 21%. Now, this is obviously a big correction happening here in the last couple of weeks. If we go back to where we were at the beginning of the year, it was much higher. It was at 36%, nearly double, right? But if we look at EZU on a euro base, that's where things start changing. But the problem here is that you have to basically account for the fact that the euro has been such a dog that like the system is good, but it's good if you're in euros. If you're in dollars, you're essentially already trading against that because you're not holding euros. So the idea that, as an American, you're looking at this from a perspective, okay, I'm looking from America to Europe, but the way that the system is moving is implying that you're holding euros. So it's almost a counterintuitive, right? Because like for us, we're already experiencing some of the positive effects of the dollar. Now, maybe that does start to roll off and it becomes a tailwind for euro assets long term. If Trump really can get the dollar from 103, maybe to 95 or lower. But right now, it's just not what we're seeing. So I want to release it, but it's just hard to actually put positions on around it, given we're working with dollars. But maybe the European followers they can have more. They could find more alpha with it, given that some of them probably have a lot more money in euros as just savings and whatnot.
Yeah. Well, I think the way to use it for us, like we wouldn't really trade European markets, but the way that we could use it is um, just getting an idea of the global landscape and
Oh, absolutely,
how,
yeah.
because everything affects America. Like if Europe's going to shit, it's going to affect America. If Europe's doing good, it's going to affect America. And also being able to analyze that data and finding historically what kind of system outputs affect America in what ways and which
Y-
assets. And
Yeah.
there's definitely
So that brings up a good
a lot
question.
of good room for extra stuff that we could do.
That brings up a good question because I put this up on X earlier, right? So I'm sitting there, I'm thinking like, okay, like I always like to play these games in my head. Say like America's fucked, right? It's over for America, cooked, finito, done, washed up. The trade's now Europe. I'm like, okay, why would that be? How does that happen? Well, if the trade's going to be Europe, it's under one specific situation. The European economy, right, is going to face in a revolution, right, that is going to oust America's position as significantly weaken America's position as reserve status or reserve currency status in the world. And I go, okay, it's possible. But in that scenario, if America were to experience this severe fiscal withdrawal, right? Fiscal withdrawal being like the deficit reductions, likely in that case, if it's severe enough, a recession. And then in that case, probably further negative fiscal deficits to recoup out of that recession. Would that cycle affect European markets, equities, and economy? If the answer is no, then you're right. It's over for America because Europe itself and the European markets would be resilient to the blunt damage of an American recession / deeper slowdown, whatever you want to call it. But if your answer is yes, that it will bring down Europe, then you have to ask yourself why. And I believe that if America goes into a recession, Europe is fucked.
Yeah. I mean, we
right?
pretty much saw a recession in Europe. They cut rates way deeper than America did. Every country cut rates more than America because they had to. America's the only
Right.
one that was able to stand on its 2 feet. But
But
yeah,
like let's just look at let's just look at EZU to SPY, like right? Like back in 2022. Right? EZU to SPY. So 2022. Long EZU short SPY, made some money for some time into 2023 and pissed it all away, right? So there's been no real relative outperformance here, maybe marginally since the 2022 lows. But going into 2022, when the Fed started hiking rates, long euro short SPY, you smoked yourself. The European markets actually got hit harder than America, and America did. We were basically lifting off of 0 to 500 basis points. So you have to understand that like your bet on this trade on the European new economy is that America is not as significant globally as it is right. It will become less significant. If you believe that, then there is some merit, there is some cause to be long Europe longer term. But I have a feeling this is more of just like an unwind. Like it's just some like a relief that we're seeing. And this happens, like go back in time. Like, we see things like look in 2017 out of nowhere. I'm sure when this started happening in 17, everyone was like, and this miraculously happens what? Right after the election? Pretty much, right? 2016 election, right? Trump's in office. You get the rise.
yeah, I wonder if it's like the same
Right.
rationale behind this move.
right. Right. So like I'm not drawing conclusions here. I'm just saying like sometimes things happen sporadically and they're not really quantifiable on a macro perspective because there's no long-term fundamental basis that's going to carry the trade forward. Like, is the euro going to become a dominant currency, or is it like, let's just look at euro USD, right? Like, is the euro going to become a dominant currency here? Like, are we going to really start to weaken or is the dollar really going to start to weaken significantly against the euro long term? Or what happens here is if the US experiences a slowdown / recession, does it bleed over to Europe and then the ECB has to go back to pretty much zero? Right? Like
Yeah.
like if you look at euro, let's see, interest rates, let's see if they'll show. Yeah. Right now we're at 265 in the euro, right? Like ultimately the European economy is long term has been a weaker economy than America. So the question is like if we have a real slowdown in America that's larger than what we're seeing now, they're already at 2.6, 2.7, they'll be in the ones, right? They'll be the rate differentials should actually widen in that scenario where the dollar gets stronger if the US goes into a recession. Unless of course the euro is no longer attached to the American economy the way that people are making it out to be. In that case, well, then you have a fundamental basis to be long Europe. And I don't see that right now. I don't see how you're going to recapitalize the market outside of like, again, we go back to that world map of the world list of all the major companies on planet Earth. They're dollar based. They're domiciled in America. Unless you start really shifting things to Europe, I just don't see it. I just don't see it. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on our website at market-radar.com or X at the Market Radar.